Welcome to Illuminati Silver. We tell the truth about silver. Today is Saturday, the 7th of December 2019. And earlier today we produced our gold and silver weekly update, where we highlighted why gold, and particularly silver, prices fell so dramatically on Friday, and what is in store for the week ahead. Now, as a prelude to the update video, we also produced one late yesterday, entitled Gold and Silver Dives as US Jobs Skyrocket. And we suggest that you perhaps, if you can, listen to them more or less back to back. And we've placed links to both of these in the description box below. Now, a few weeks ago, we published a range of videos covering both the equity markets and the bond markets, where we pointed out that our analysis suggested that equities were likely to hit all-time record highs on a number of successive occasions, which has happened. And whilst the bond markets would suffer from a slight depletion of funds because of negative yields, they would also benefit because of potential capital gains on existing bonds and new bonds as the prospects of lower rates and negative yields further reducing lay ahead. Now, an interesting article we came across in this week's Financial Advisor, which is a weekly publication for the UK financial advisory sector and fund managers, published by the Financial Times, asks the question, is it now time to turn away from bonds? The article is written by Vincent, who is a co-portfolio manager of the TBY's Multi-Asset Growth Fund, a fund worth around £58 million and holds a diversified portfolio of collective instruments, including unit trusts, OEICs, and investment trusts, which is authorised also to hold shares, fixed interests, commercial property, and alternatives in any combination anywhere in the world. So they have quite a wide range of potential investments within their fund. So, let's listen to the article. Time to Turn Away from Bonds by Vincent, co-portfolio manager of the TBY's Multi-Asset Growth Fund. Stocks are bonds and bonds are stocks. Such has been the extreme impact of ultra-loose monetary policy and sustained high levels of risk aversion that traditional market thinking has been firmly turned on its head. Equity investors now come to the market for income, while bond investors are seekers of capital return. So pronounced is this strange dynamic, it has reached the stage where investors are queuing up to hold negatively yielding government bonds and some credit guaranteed to lose money on maturity. Few, if any, would have predicted such an outcome. It is hard to envisage a catalyst that will see a significant rise in bond yields over the short run. Brexit, global trade wars, low levels of global growth, and the absence of inflation are likely to see rates suppressed for some time yet, supporting the lower for longer thesis. However, this does not discount the potential for a shock event risk that could see yields spike. Global equities have remained buoyant at the same time as sovereign bonds have continued to rise, leading to a third of global bonds yielding negative rates. In the long term, both markets cannot be right. This is the stark conundrum currently facing investors. One cannot, at the same time, be willing to take equity risk and be so keen to protect assets that one is prepared to suffer a guaranteed loss on sovereign bonds. We believe, given this potential turbulent outlook for bonds, investors must consider the relative merit of investing in both government bonds and corporate bonds. The first question is, are you prepared to wade into the fixed income waters? While there is still positive yield to be found in government debt and credit, one only needs to assess duration risk to understand that even a 1% move in rates will have a damaging impact on portfolio returns. The second question is, are you being rewarded for this risk? We believe this is an unequivocal no. Considering what is available outside the bond universe, and particularly in the world of defensive equities. This is not to say equity markets are not also a complex place to navigate. There are dichotomies within equity markets themselves. Among the top global sectors in terms of recent performance are consumer staples, expensive quality yielding assets with stable growth, technology, expensive non-yielding growth assets, and utilities, cheap defensive yielding assets. It appears investors are simultaneously looking for yield, protection, and continued upside participation. One would argue not all three requirements can be fulfilled at the same time, which implies these market dichotomies will have to be resolved one way or another. We believe when market direction is uncertain and obvious inconsistencies appear, it is critical to stick to a valuation discipline. This can prove painful until rational behavior reinstates itself. However, ultimately, buying assets that are cheap relative to their intrinsic worth and avoiding overpaying are the best ways to prevent significant losses in the future. Hence, we view the utilities and infrastructure sectors as attractive defensive alternatives to government bonds. Both sectors produce consistent income with low volatility and have historically been less correlated to traditional asset classes. The net effect of an allocation to these sectors is the addition of slow and steady growth exposure in the portfolio. The managers we select in this space focus on global companies with high barriers to entry that fulfill a critical need in their respective markets. Moreover, far from being boring, the best of these companies can grow at a steady pace. This is due to either increasing demand for their services, supported by both developed market upgrading and developing market growth, or helped by regulatory regimes allowing companies to increase prices in line with inflation. In addition, these companies get exposure to some of the fast-growing areas using renewable energy, while still offering better downside protection when sentiment turns. Their defensive nature, tied to structural growth, is also favoured as investors rotate out of cyclical trades such as tech or industrials during periods of choppy market weather. Were inflation to rise, both utilities and infrastructure act as valuable hedges, with many companies in the sector possessing inflation-linked cash flows which can act as a portfolio ballast in times of rising prices. They also deliver high and rising dividends. As central banks run out of monetary stimulus tools, we are likely to see a pivot from monetary stimulus towards fiscal stimulus. We expect infrastructure names to benefit quite strongly from this tailwind. No one knows exactly when or if the bond market might blow up. However, given current relative valuations, we believe there's a strong investment case for holding utilities and infrastructure equities that offer attractive, predictable, and growing dividend yields without foregoing capital growth. A summary of this article can perhaps be condensed into 3 points. 1. Conventional market allocations have changed due to loose monetary policy. 2. There is a turbulent outlook ahead for bonds. And 3. Utilities and infrastructure equities are a good diversifier away from bonds. Articles such as these are important to take note of, and we shall now explain why. In our simple gold and silver universe, and especially that universe exemplified and articulated by whom we term the gold and silver pumpers, one could be forgiven for thinking that If investors do not invest in equities, they have to invest in gold and silver. Or if bonds become unattractive, they have to invest in gold and silver. If property prices fall, they have to invest in gold and silver. Negative interest rates means all bonds will be sold, and people will have to invest in gold and silver. Well, articles such as these provide us with the thinking behind those money managers who are, in this case, managing multiple £1,000,000 or dollar portfolios, and others who manage multiple billion dollar or pound portfolios. And they show us that these investment managers, do not necessarily agree that gold and silver are the only alternative investment classes open to them. You see, Vincent is pointing out that bonds will eventually become unattractive, especially when rate reductions are likely to cease on the horizon, thereby limiting any potential capital growth for those bonds held, or rates reduced to such extreme negative yielding at levels it will be economic suicide to hold them, as all of the capital appreciation will have already been gained and returns further adversely affected. But he is also pointing out that certain equities may be the go-to place for those funds, especially utilities, income-generating and infrastructure-type stocks, even when general stock market levels may fall. Now, it goes without saying, when these movements do take place, of course, gold and then eventually silver will benefit. Some monies will be heading in that direction, but it may be a long drawn-out process as each investment class matures or their bubbles burst. This is one of the reasons we can see before us even today that whilst both gold and silver has held up well this year, with gold up around 18% and silver up around 14% to the present day, other asset classes have also done well, even though their markets were projected and predicted to have been in bubble territory last year, if not the year before. Now, we're not saying for one moment that one should forget gold and silver and plough one's monies into defensive equities. But what we are saying is that this is what a number of key money managers are doing and are thinking of doing. And this is one reason as to why we have not really seen the dramatic appreciation in gold and silver prices many were either anticipating or hoping for. There is, of course, time, and over the longer term we shall see the gains, which is why we have always suggested ignoring the pumpers, that you have to invest today, and that a gradual, regular investment is likely to serve you well and unlikely to serve you badly. Thank you for listening. Do share your thoughts on this article and our comments. And if you haven't already done so, please subscribe to our channel. Press the bell sign so that you're notified of videos as and when they are published. And pop along to illuminatisilver.com and sign up as a free or paying member. And finally, just as a reminder, we have provided links to the videos mentioned earlier in the description box below, plus 3 important videos that we have been highlighting now for a few days. $100 silver and silver supplies squeeze coming soon, highlighting really how the clickbaiters are creating really a false incentive. $100 plus silver really, why we believe it's very unlikely in the near future, and is there really a silver supply squeeze developing? And we suspect not, which is another reason we have just seen prices fall. Thank you once again, until our next podcast video. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.